On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi team, that's another week down, and it was a very good one for investors. Global share markets rebounded strongly from the weakness that we've seen of late. Investors encouraged by softer economic indicators, more evidence of easing labour markets that will hopefully mean interest rates and bond yields are close to a peak. The S&P 500 surged 5.9%. That's its best weekly performance in a year. And that comes on the back of a 10% decline since the end of July. So a very welcome rebound after a difficult 3 months. Other markets were also much higher. We saw the European market rise 3.4%. The FTSE 100 in the UK was up 1.7%. The Australian market added 2.2%. And the local market here in New Zealand was up 3.3%. That's our best weekly performance in 16 months. However, we are still down slightly this calendar year. The local market at the moment is down 3.1% in 2023. So we're still dragging the chain a little bit. Some of those other markets around the world are easily in the black, such as Australia, such as the US, such as Europe, but we are just behind a little bit. I did write a research report on this about a week ago, just looking at the New Zealand market, talking about its subdued performance and what it might take for things to turn around. So talk to your advisor, take a look at our website. There's also a podcast episode on it if you're interested in knowing more. Bond yields last week, they continued to decline. We saw the US 10-year Treasury yield fall from 4.8 to just shy of 4.6. Listeners will remember that a couple of weeks back, it pushed over 5% for the first time since 2007. So it's come back quite a long way from those multi-year highs. And it was a similar story here in New Zealand. We saw our 5-year swap rate fall 24 basis points to 5.02. So we're at the lowest levels in about 2 months as well. If we look back at last week's events, and we'll start here in New Zealand. Well, first of all, we got that final election result on Friday after the special votes were included. And I think it largely came in as expected. National lost 2 seats. Which is the same as what they lost in 2020 and in 2017 after the special votes were counted. So not a huge surprise. What it does mean is that National and ACT don't have a majority together and they will need New Zealand first. I think we all knew that. I certainly did. That was my expectation, and I think National knew that. It does appear that they have been talking with New Zealand first over the last couple of weeks, so I think they probably weren't surprised by that result. So from here, just give it a week or two. Hopefully it doesn't take any longer than that, and we will get confirmation of what that final government will look like, and we'll hopefully see a little bit more about sort of what sort of policies from each of those 3 parties will be adopted and which ones won't, and if there's any sort of concessions amongst that policy mix, as well as some of those key positions in cabinet and so forth. So more to come on that front, but look, I don't think there was a huge reaction from financial markets or investors because it was sort of the result that we were all really expecting. Business confidence here in New Zealand, we had the October Business Outlook survey from ANZ, and we saw another nice bump up in sentiment, which is fantastic. Headline confidence rose to the highest levels since 2017, so the highest in more than 6 years. The Own Activity Index, which is actually the one I watch when I want to get a good guide to what's going to happen in the future. This measure does correlate quite well with future economic activity. It was also up sharply. It rose to the highest levels since July of 2021. So that was good news. Business confidence continuing to push higher. The big release we had here in New Zealand was our September quarter labour force report, unemployment and so forth. And what we saw is that employment fell during the quarter. So that was below forecasts. People were expecting it to increase, and it fell slightly. So that's the weakest that we've seen since last year, since the middle of last year. We also saw the headline unemployment rate increase. It went up to 3.9%, which is still very low. Anything starting with a 3 is very low, but it's the highest in more than 2 years. And it's above that multi-decade low that we saw in early 2022, 3.2% we got to back then. That was the lowest level since the early 1980s. So we are seeing unemployment creep up. It's partly due to migration that is adding to the labour pool. But what it tells us is that the labour market is easing up, and it's a bit easier for businesses to find workers, which is a good thing. And going hand in hand with that, we saw wage growth keep moderating. The labour cost index rose 1.1% for the quarter. And when you look at the annual change, that is sitting at 4.3%. So that was largely as expected, the same as the previous quarter, actually. But interestingly, a lot of that strength was driven by public sector wage increases, teachers or nurses or some of those public sector professions that got well-deserved pay rises. But those are ones that you won't see every year, such that we shouldn't expect those to happen next year and the year after. So you can sort of look through that to a degree. When you isolate just the private sector labour cost index, it increased at a much more modest rate, just 0.9% for the quarter, which was actually below Reserve Bank forecasts. And the annual growth rate slowed to 4.1%. So that's the lowest we've seen in a year. So this is all a good thing from the perspective of what the Reserve Bank might do next, because one of the reasons we've had high inflation is a very tight labour market, which has fed through to very strong wage rises. And while those are fantastic, they do lead to broader inflation because companies put their prices up to sort of recoup the wages, and you get into that wage price spiral. So it's been a crucial piece of the puzzle that we've needed to see before we can get to a point where the Reserve Bank feels a bit more comfortable. So a little bit higher unemployment and a bit of a softening in that wage growth is exactly what we want to see. To give us confidence that the Reserve Bank is done and that they won't need to do any more, and that next year might be the year where they start thinking about reducing the OCR. So that was very well received by the market. Also in New Zealand, we had the Reserve Bank's financial stability report. They release these every 6 months. It's more of sort of a big picture look at risks across the economy. So it doesn't have huge implications for financial markets in a short-term sense, or the currency or interest rates, or even monetary policy. But it's an interesting read. The Reserve Bank talked about a lot of things in this report, but some of the interesting points they made were that they do expect pockets of stress to emerge amongst some highly indebted households. And I guess that's pretty obvious with debt servicing costs having risen. There will be some out there that have maybe bitten off a little bit more than they can chew. So we haven't seen that yet, but the Reserve Bank does expect that, amongst a relatively small group. And a large rise in unemployment is something they see as a key risk, because that would obviously have an impact on people's ability to sort of pay those debt costs and so forth. So they singled out those things. Dairy farmers, they talked a little about the dairy sector, the agricultural sector. Their view is that a lot of dairy farmers will make a loss this season, especially those with higher debt levels, given we've got a lower payout and increased costs. Again, that's something we already know and that we would agree with. The Reserve Bank thinks that is manageable as long as it only lasts for one season. So if we saw a prolonged downturn in prices, that's when things could become quite difficult. So I tend to agree with that. You don't want to see the low payout and the very high borrowing costs hang around for 2 seasons or 3 seasons. That's when you'll see more widespread issues emerge. Generally, the Reserve Bank thinks that our banking system is pretty well placed to handle a shock or a downturn. Banks have got good liquidity. Capital positions are strong, so they're reasonably comfortable, but they do see some of those potential risks. So those are the sorts of things they're watching out for. Internationally, there was a lot going on last week. We had some Chinese PMIs. These are activity indicators. They were for the month of October. They pointed to slower momentum, renewed deflationary pressures, weakness in the services sector, which has been an area of strength. So the composite PMI, which covers both manufacturing and services, fell to 50.7. So 50 is your break even, only just above that, and the weakest since late last year, actually. So not fantastic news out of China. In the US, there was a lot going on. We had the ISM surveys. ISM stands for Institute of Supply Management. The manufacturing index came in a lot weaker than expected. This was a bit of a surprise. It fell to 46.7. People were expecting it to be 49, so it's quite a big miss. The new orders component of that survey slumped as well. That was the weakest since May. The services ISM index also below forecast. So all of these indicators really did tell us that the economy has maybe just started to slow down more than we thought through this last month or so. Then we got the jobs report on Friday, and this was the big one. And the market took this really well. It looked very similar to what we've seen with the New Zealand labour force figures, because in the US, the headline payrolls number was below forecasts. It was actually the second lowest since the end of 2020. We get these figures every month. So you've had all of 2021, all of 2022, and the first 10 months of this year. And this month was the second lowest. So things definitely are softening. The headline unemployment rate increased to 3.9%. So again, that's the same as us. And just like us, the US had a very low unemployment rate not so long ago. They fell to 3.4 back in April, and that was the lowest we'd seen since the late 1960s. So 3.9 is still very low, but it's quite a jump from 3.4. Wage growth also softer. Average hourly earnings rose by less than expected. On an annual basis, it slowed to 4.1. So that's still high, but it's the lowest in more than 2 years. So you put all of that together, and it does add to hopes that the Federal Reserve is getting the slowdown that it needs to see inflation pressures keep moderating, and those interest rates are doing their job. So this was taken very well, as it gives us hope that things are moving in the right direction. That bad news was actually good news. Lots was happening on the central bank front last week. We had the Bank of Japan, the Federal Reserve in the US, and the Bank of England. And the Bank of Japan took another step toward ending its yield curve control policy settings. They introduced these in 2016, and it was to keep bond yields very low, right across the spectrum, right through to the longer dated maturities. They were trying to encourage consumers to spend, businesses to invest, and they did that at a time where deflationary risks were very high. Inflation was running well below their targets, but things have changed now, and their annual inflation rate it's been above 3% for more than a year, and their core inflation rate's been above 4% for more than 6 months. And that's the first time we've seen that since 1981 or thereabouts. So they're at a point where they can start removing some of that stimulus, and they'll do it very slowly, but we saw a step towards that last week, I should say. So they've still got a negative interest rate, but they are just loosening up the upper limit that they will let those 10-year government bond yields trade at. So I think you'll see more of this from the Bank of Japan. They're sort of the last man standing, in the sense that every other central bank has given up on those very stimulative policies and the negative interest rates and the QE and all of that. But the Bank of Japan still is doing much of that. So I think we will see more of a shift from them in the future. And this was just a step down that path. The Federal Reserve in the US was the big one. They left their policy rate unchanged at 5.5. That's the same as ours, same as our OCR here in New Zealand. And it's the highest we've seen in the US since 2001. So no change there. That was expected. Everyone focused on the comments and sort of how they worded it. And to be honest, they hedged their bets and they played their cards pretty close to their chest. There's one more Federal Reserve meeting to come this year that will come in mid-December. and they're leaving the door open for a move at that time, but I just can't see it, to be honest. And looking at the jobs report and the rise in unemployment and the easing in the wage growth and some of these other indicators that are starting to soften, my personal view is that the Fed is done and we're at the top, and that next year, at some point, we will see interest rate cuts. You never know; things could change. The Fed itself is talking about higher for longer, but higher for longer will only last while current conditions are as they are. If you see economic weakness emerge, if you see the labour market continue to ease, they will change their mind, and that is my feeling of how things will develop. Could say the same about the Reserve Bank here in New Zealand. I think they're at the top as well, and I think that we might see an OCR cut potentially sooner than they're suggesting. We will see one. Time will tell. Bank of England, that was the third one from last week. They left their policy rate unchanged for the second meeting in a row. They're at 5.25. That's the highest since 2008. They're hedging their bets too, and there's an outside chance that we'll see the Bank of England move again, but I think there's a better chance that they also are at the top. So it's quite interesting. We're at a bit of a turning point lately. At the moment, people have got a bit more confidence that many of these central banks are done. The New Zealand Central Bank, the US Central Bank, England, Europe, all of those, there's a good chance that they have reached the top of the hill, and that from here it's just a matter of how long do they stay at those levels and when do we see the first cut. The Bank of Japan, obviously a different story. We've covered that. And the other big central bank that might still have a little bit of work to do is the Reserve Bank of Australia. And they're meeting this week. They meet on Tuesday afternoon. They have a cash rate of 4.1%. That's the highest since 2012. They started increasing that in May last year. So they're a little bit behind us, which is why it's one reason why they've got a little bit more work to do. Remember, we increased our OCR for the first time in October 2021. It would have been in August of that year if it wasn't for another outbreak that sort of just happened right on the cusp of the decision. But we started hiking in October 2021. Australia didn't start until May of the following year. So they're definitely behind us. So we have the luxury of just sitting tight now because we've made all that effort. And they started later, so they've still got some work to do. So on Tuesday afternoon, I'd say this one's a coin flip, 50-50, whether they hike rates again. They might not, but looking at the last set of inflation figures, the preferred measure that they use, which is called the trimmed mean, that rose 1.3% for the quarter. Most people were only expecting 1.0. The annual rate of inflation slowed to 5.2, which is down, but people were expecting it to be more down than that. So there is a bit of pressure on the RBA, and I think there's a decent chance that they will make a move on Tuesday. So we'll be watching that one. Here in New Zealand, what are we watching? The Reserve Bank has its quarterly survey of expectations. This will be released on Thursday, and this is where they survey a selection of business leaders, forecasters, economists, and it's just a way of them monitoring what people think. So I think what you'll see is inflation expectations will keep trending lower. That's what they'll be expecting. That's what they'll need to see. This has been going in the right direction, so I can't see it being something that will move the market or provide any big supplies. Hopefully it will just be something else that gives us comfort that things are on track. We've got a dairy auction to come early Wednesday morning, and the dairy prices had a nice rebound. The last four auctions, we've seen prices rise, and the rise has been about 16 or 17% over those four auctions. That obviously came on the back of a big slump that saw prices fall to the lowest levels in 5 years in mid-August. And that saw Fonterra cut its payout forecast, a couple of times in quick succession. But since we've seen this nice little rebound, prices are still low, but at least Fonterra has increased that forecast payout range, and they're now at a midpoint of 7.25. They were in the sixes before, so it's better to be in the sevens than the sixes. At 7.25, it's still going to be tough for some dairy farmers, particularly if you're highly leveraged and if you're carrying high debt levels. but that's at least something that looks a little bit more respectable. So hopefully we will see dairy prices at least be stable, or hopefully even push a little bit higher. Internationally, what will I be watching internationally? On Monday, we've got the Fed's Senior Loan Officer Opinion Survey, SLOOS is what they call it, because that's what the acronym is. That's out on Monday. That's usually a really good gauge of how tight bank lending conditions are. So we'll be watching that, because obviously with bond yields having gone up until last week, they were rising a lot. So that will have an impact on bank lending and conditions. The University of Michigan survey's out on Friday, so we'll be watching some of the indicators in that. Across the Atlantic in the UK, we've got monthly GDP will be released, so that'll be interesting. After the Bank of England last week, they didn't move interest rates, but they did warn of recessionary risks, so we'll see if there's any evidence of things changing on that front. The RBA I've mentioned as the only major central bank that has a monetary policy decision, but we will be watching some speakers from some of the other big central banks around the world. The International Monetary Fund is holding its annual research conference on Thursday. Fed Chair Jerome Powell will be speaking at that, so that will be closely watched. I think there are also appearances from some of the other big central bank representatives, and some of the other officials from the Federal Reserve will also be on the speaking circuit for most of the week. So I think every day this week you'll see headlines about what someone from the Federal Reserve has been saying or thinking. But Powell will be the focal point, and that is on Thursday. The reporting season will continue. The global reporting season, it's sort of winding down now. We're in the tail end of it. 80% of the S&P 500 has already reported, but there is another 50 or 60 companies reporting this week, so there's still a few to come. It's been fairly good so far. Of those 80 odd percent of the S&P 500 that's reported, so it's about 400 odd companies. 4 out of 5 have exceeded their earnings forecast, so that's good. And the index in aggregate is on track to increase earnings relative to the same quarter a year ago, to increase earnings by about 2 or 3%. Now, that's ahead of what we were expecting before the reporting season. At that point, people were expecting a decline in earnings from the same quarter a year ago. So it's turned out better than expected, and it will actually be the first increase we've seen in about a year. I think something that is weighing on the market are outlook commentaries. So while earnings have come in pretty solid for the September quarter, when CEOs and management teams are talking about what's coming, what's on the horizon, they have been a little bit downbeaten. We've seen a few high profile companies such as Apple that have disappointed the market in terms of those outlook commentaries. So that's something to watch. But this week we'll hear from lots of companies, another few dozen out of the US and elsewhere: Fastenal, Adidas, Disney, Illumina, Sony. So those are some of the big ones that are on my list. We've also got a bit happening on the local front in terms of corporate news. A few AGMs. We've got Chorus, Sky TV, Vulcan Steel, Heartland, KMD Brands, that's the old Kathmandu, and Mainfreight is releasing its interim result on Thursday. Mainfreight is one of the real market heavyweights. Everyone's got Mainfreight in their portfolio. Very widely followed, widely owned, fantastic business. Had a bit of a difficult year. It's down about 10% or so this year, so it has lagged the market a little bit. It touches a lot of parts of the economy, and it's quite sensitive to changes in the economy, and it's also a very global business. So they're big in Europe, they're in the US, they're big in Australia. So you learn a lot when you read and listen to the Mainfreight result. This time I'm particularly interested in what they've got to say about how things are going, because it does feel like we're at a bit of a turning point in the economy. And if you look at the AGM comments we saw from Freightways and Port of Tauranga a week or two back, they didn't make for particularly upbeat reading. They were quite subdued in terms of the read-through for how economic activity is tracking, and how some of these businesses in that broader logistics and transport space are faring. So Mainfreight will be definitely one to watch on Thursday. Across the Tasman, Westpac, Hardee's, National Australia Bank, all reporting results, and I think Xero which is sort of an Australian company because it's listed over there, but I still like to think of it as a New Zealand business. But I think Xero also has an interim result on Thursday this week, so that will be of interest too. Right, that's us. Lots going on. Let's hope some of that optimism and positivity from last week can carry on through the rest of the year, starting with this week. So enjoy the next 5 days, everybody, and we will talk again soon.